Problem number 11. Transfer pricing. PEX is a manufacturing company of which division PQR manufactures a single standardized product. Some of the output is sold externally, whilst the remainder is transferred to division RPQ, where it is a sub-assembly in the manufacture of that division's product. PQR has the capacity, they have mentioned the annual capacity to produce 30,000 units of the product. The unit cost of division PQR's products is as under. So they have given the unit costs here, in which direct material is there rupees 40, direct labor rupees 20, direct expenses rupees 20, variable manufacturing overheads rupees 20, fixed manufacturing overhead rupees 40. So fixed manufacturing overhead in any way, in any transfer pricing problem, this is not going to affect the transfer pricing decisions. Hence we will never use fixed manufacturing overhead unless it is a specific fixed overhead or a step fixed overhead. So sales and packaging expenses, which is variable, rupees 10. So overall it is coming rupees 150. Annually 20,000 units of the product are sold externally at the standard price of rupees 300 per unit. In addition to the external sales, 10,000 units are transferred annually to division RPQ at an internal transfer price of rupees 290 per unit. This transfer price is obtained by deducting variable selling and packaging expenses from the external price, since those expenses are not incurred for internal transfers. Division RPQ incorporates the transferred in goods into a more advanced product. The unit cost of this product are as follows. First one is the transfer price from division PQR, rupees 290. Then direct material and components, rupees 230. Direct labor, rupees 30. Variable overhead, rupees 120. Fixed overhead, rupees 120. Then selling and packaging expenses, which is variable, rupees 10, and overall it comes around rupees 800. Division RPQ's manager disagrees with the basis used to set the transfer price. He argues that the transfers should be made at variable cost plus an agreed, means minimum markup, because his division is taking output that division PQR would be enabled to sell at the price of rupees 300. Partly because of this disagreement, a study of the relationship between selling price and demand has recently been carried out for each division by the company's sales director. The study has brought out the following demand schedule. So the director has given two schedules of the demand. So first one he has given for division PQR. So it says if the selling price is 200, the maximum demand can be 30,000 units, and if the selling price goes to 300, the demand can drop down to 20,000. Just like that, if it goes to 400 rupees, the demand drops down to 10,000, and just like that, division RPQ, if the selling price is rupees 800, demand in units may be 14,400. If the selling price goes up to 900, the demand can be 10,000, and if the selling price is 1,000, the demand can be 5,600. So the manager of the division RPQ claims that this study supports his case. He suggests that a transfer price of rupees 120 would give division PQR a reasonable contribution to its fixed overhead, while allowing division RPQ to earn a reasonable profit. He also believes that it would lead to an increase of output and an improvement in the overall level of company profits. So required is calculate the effect of the transfer price of rupees 290 per unit on company's operating profit. Calculate the optimal product mix. Then advise the company on whether the transfer price should be revised to rupees 120 per unit. So see, first of all you should know the contribution analysis of division. One second, first of all you should understand the question itself. See, two divisions are there, PQR and RPQ. So RPQ is having two segments of market. One segment is like the external segment where it is selling the 20,000 units, and another segment is the internal transfer, that another division, which is RPQ. So the division PQR is selling outside market at rupees 300. Okay, so that's how it is arguing with, sorry, that RPQ division is there, that he is arguing that one second, sorry, yeah, that's what he is arguing, that PQR division, like if I am able to sell outside at 300 rupees, why can't this another division RPQ accepts it at why can't the division RPQ accept it as at 300 rupees, and in 300 he is giving 10 rupees discount, means ultimately this division PQR wants RPQ to accept the price of 290. Why 10 rupees they are giving discount? Because of this sales and package expenses. One second. This one, sales and package expenses. Okay, so because if they are selling it outside, they have to incur this sales and package expenses also, whereas if they are selling internally, they don't have to incur this. That's why they are expecting them to quote the price of 290. And on the other side, this division RPQ is saying, see, Mr. PQR division, you are not supposed to quote rupees 290 because you are selling only those products to me which you are not able to sell in the outside market. Because, and that his argument is being supported by the study of the sales director also. This study is done now. It's saying that, see, if the division PQR is quoting 300 rupees, they are able to sell only 20,000. So how much is the balance? 10,000. So 10,000, if they are not able to sell outside market, what they can do? Nothing they can do, and those units only they are transferring to RPQ. So logically this is right only. So what they are saying, the manager of the division RPQ claims that this study supports this case. He suggests that a transfer price of 120 would give. So he is suggesting that, okay, you can quote rupees 120. Okay, he is suggesting that you can quote rupees 120. So what we have to do, we have to see, like, if 290 is selected as transfer price, what will be the effect on overall company's profitability, or if 120 as suggested by this manager of division PQR, if that 120 is, if we are selecting, what will be the overall effect on the profitability of the company. So here they are saying, calculate the effect of the transfer price of rupees 290 per unit on company's operating profit. Okay, so first requirement is that we have to keep rupees 290 as transfer price, and then we have to see what is its effect on company's operating profit. In second, we have to see, if we are revising the transfer price to 120, what will be the effect of the same on the company's profitability as a whole. So see, first thing what they have done, first thing they found out the contribution. Okay, contribution they found out in keeping all the selling prices. See, the different selling prices are there, 200, 300, 400. This they have done for division PQR. Division PQR. One second. This division PQR. Okay. So 200, 300, 400. Then variable cost rupees 110. 110 is where they got from here. See this 40 plus 20 plus 20 plus 20. Fixed manufacturing overhead we should not consider. Then this sales and packaging is included. So 4, 5, 6, 7, 8, 9, 10, 11. So 110 they have taken here. 110 variable cost they have considered here. So if you deduct that, you'll get contribution per unit. Sales minus variable cost, obviously contribution. Okay. Then demand. If you are selecting 200 rupees as selling price, the demand can go up to 300. Just like that. If selecting 300 rupees, demand will drop down to 20,000. Same like if you are selecting 400 rupees, demand will come down to 10,000. So contribution into this demand units, you'll get the total contribution. So this is the total contribution of division PQR. So what it's saying, the above table shows rupees 300 price to be the most profitable, and that cutting prices would not result in increased profit. So see, it is clearly visible, no? Like if you are selecting 300 as price, your total contribution is highest here among the three. 38 lakh. So if you are reducing price to 200 also, you are not able to catch up to this much of contribution. So the best one is 300 rupees. Now division RPQ. Division RPQ also, see, you can have the selling price of 800, 900. This is selling to outside market, no? So this is the outside market price. So 800, it may be 900 or 1000. That's what they have taken here. Then variable cost, where they got, this is the variable cost of the division RPQ. So 290 plus 230 plus 30 plus 120, again fixed overhead we will not consider. Then rupees 10. If you total, it will come around 680. So 800 minus 680, contribution 120. And here 900 minus 680, contribution 220. And here 320. And just like that, demand units they have taken with each selling price, respective demands are there. So that we have taken here. Okay. Then if you multiply the contribution with demand units, you will get this. Okay. So here the highest contribution you are getting if you are selecting 900 units. So by seeing this, what we can conclude is, if we see this division PQR, then division PQR will select this 20,000 units only. Okay. And if we see division RPQ, it will also select 20,000 units. Sorry, it will select 10,000 units for receiving. Okay, because that is the highest. Then contribution division RPQ. One second. So here we got the contribution keeping the transfer prices 290. Again we have to see if the transfer price is 120, whether the contribution changes or not. So that's why it's done here. Selling price is 800, 900, 1000. Variable cost 510. How 510 has come? Because here this one is there, no? Transferred in an item, instead of 290 they have taken 120. That much only is the difference here. Okay, if you remove 290, instead of 290 if you take 120, variable cost is 510. Okay, so the contribution per unit comes 290, 390 and 490. The demand units obviously is same only. So total contribution comes 41 lakh 76, 39 lakh and 27 lakh 44,000. So if we are selecting transfer price is 120, total contribution is higher. If 14,400 units are taken as transferred units from that PQR division, okay, then this big para is there. This we have to decide. Why we have to decide that? Because in the question they have said calculate the optimal product mix. Okay, calculate the optimal product mix. So see, first one, whatever they are saying in this entire para, I'll tell you here the gist. So it is saying like first option is like the PQR division can go with the option like 20,000 they can sell it outside market and 10,000 they can give to RPQ. That is the first option. Or second option is like one second, the question is there, no? See, this question is there. So see, now they are first option is this one, 20,000 they can sell to outside market, and if they are selling 20,000 to outside market, the remaining is 10,000 which they can transfer to RPQ. And second option can be only this one, like 10,000 to outside market, and the balance whatever is remaining, whatever extent they can transfer to RPQ is 14,400. That is the second option. Why not this 30,000? Because RPQ want internal transfer only. So if they are selling 30,000 to outside market, they will not be able to transfer to RPQ. That's why this option is ruled out. Okay, so that's why second option is this one taken, like 10,000 they can sell it to outside market, and if 10,000 they are selling to outside market, how much capacity they are having? Out of 30,000, 10,000 gone to outsiders, 20,000 remaining. So out of 20,000 they can transfer internally 14,400. So that is the second option. Now third option, see, RPQ one demand is 5,600. So that this one is ruled out because RPQ want 10,000 units. RPQ wants 10,000 units minimum for the transfer from PQR. Okay, so 10,000, one second, so PQR can sell outside 10,000 and send RPQ 10,000. That is the third option. This one ruled out, this one ruled out. So this is the third option. Okay, first option we took 20,000 and 10,000. Second option we took 10,000 and 14,400. And third option 10,000 10,000. That's what is done here. Okay, now that's what is written here, that's what is written here. Okay, now we got this mix. Okay, now we have to find out the overall profitability of the company. If transfer price we are selecting as 290, so see, based on this mix we are taking the units here. So PQR external sales are there, then transfer to RPQ. So 20,000 10,000 and transfer to RPQ is 10,000 14,400 and 10,000. So see, contribution to division PQR. what contribution division PQR will get if they are selling externally. See, if they are selling externally 20,000, you go back to the previous table. Okay, if they are selling externally 20,000, this 20,000, how much is the contribution? 38 lakh. That's what is taken here, 38 lakh. Okay, and if sold 10,000 to outside, then how much? 10,000, 29 lakh. Okay, 29 lakh. Here also 29 lakh, because here also 10,000 only selling to outside. Then contribution to division PQR, if they are transferring internally, this 10,000 is there, 10,000, 14,400 and 10,000. So if they are transferring internally, at what price they are transferring? At this price, 290. So 290, if they are transferring, what is the variable cost? Variable cost is 100 rupees. How 100 has come? This cost to the PQR division, 40 plus 20 plus 20 plus 20. Okay, because they are transferring internally. This they are not incurring. Okay, 10 rupees, this selling and packaging, this that they are not incurring. That's why only 100 rupees is their variable cost. That's what they have taken here. Okay, so 290 less 100, 190. So that 190 into 10,000, 19 lakh. 190 into 14,400, 27 lakh 36. And just like that here also, 190 into 10,000. Okay, so see, so one division we have done, PQR division we have done, because it is selling, once it is selling to external, once it is selling to internal. So one division complete. Now second division, RPQ is also gaining some contribution, no? So how much contribution they are gaining? See, if the units are 10,000 received, so CRPQ, the 20, this one you have to take, because 290 we selected as transfer price, no? So that's why that table we have to take. So 10,000 for 10,000 units, 22 lakh is the what we say, contribution. So that's what taken, 22 lakh. If it is 14,400, this 17 lakh 28,000. Okay, 17 lakh 28,000. Then 10,000, 22 lakh. Okay, so total contribution for the company, just total the contribution 38 lakh, 19 lakh, 22 lakh, you'll get 79 lakh, just like that for this column also, this column, on both the columns. Okay, then fixed cost is 30,000 units into 40, 10,000 units into 120. How we got that? I said for transfer pricing problem, that is fixed cost is irrelevant. Okay, actually it is irrelevant. This is just for finding out the company's profit they are asking. That's why we are considering fixed cost. Otherwise, for taking any decision in transfer pricing, fixed cost it's absolutely irrelevant. Okay, so fixed cost 30,000 into 40. This one is there, no? 40 rupees there, and they are making how many units? 30,000. They are making 30,000 units. Out of that, 20,000 they are selling outside market, and 10,000 they are transferring in whatever mix they are doing. 20,000 outside, 10,000 inside, 10,000 outside, 10,000 inside, or 10,000 outside, 14,000, 1,400 inside, like in whatever way. Okay, this fixed manufacturing overhead is fixed. So for 30,000 we have to take 30,000 into 40, 24 lakh. Sorry, 30,000 into 40, 12 lakh it will come. Then this other division is there, no? They are receiving 10,000, so 10,000 into 120, so 12 lakh there it will come. So total 24 lakh. Okay, and fixed cost will not vary with the units. That's why 24 lakh, 24 lakh, 24 lakh. Okay, if you deduct, you will get total company's profit. Okay, just like that, if you are selecting 120 as transfer price, same thing whatever I have said in this one, no, same thing you have to do here also. Okay, so see, contribution, first one is same only, second one will change because transfer price is changing here. So 120 minus 100, variable cost will be same only, right? 120 minus 100, so that 20 rupees into 10,000, 20 rupees into 14,400, 20 rupees into 10,000. That's what they have done here. Then contribution to division RPQ. Contribution to division RPQ. Okay, contribution to division RPQ. If it is RPQ, okay, if it is 10,000 unit, no, you have to see this table because transfer price is 120. We have taken transfer price is 120 here. That's why we have to take this table. Okay, so what I said. Okay, if the transfer unit is 10,000, then 39 lakh. This 1 second, this one. Okay, and if it is 14,400, 41 lakh 76. Sorry. Okay, so that's how they're done. If it is 10,000, 39 lakh. If it is 14,400, 41 lakh 76,000, 10,000, 39 lakh. So just total the total contribution for the company and reduce fixed cost, you'll get total company's profit. So see, previously what profit we got? 55 lakh, 49 lakh, 64,000 and 46 lakh. So advice we have to give, the revision of transfer price has no impact on the overall profitability of the company. However, it will alter the profitability of the divisions. Okay, that's all.